So there are four main indicators you need to be aware of in simple terms. The first one is production. All that measures is the amount of things that a country makes or produces. So this includes manufacturing, housing and construction and so on. These indicators allow the bank to see how much is being added to the economy and whether the nation is being as productive as they would like it to be or not. The next indicator would be employment. This of course measures things like how many people are in work, the percentage of people unemployed, and how much the rate that people are earning is increasing. This also includes sub-indicators such as average earnings, unemployment rate, claimed accounts, and so on. Similar to production, this indicates to the bank and to the traders how well the economy is doing. High employment data and low claim accounts are usually viewed positively and will have a bullish signal on the currency. Thirdly, we have growth. The most popular indicator in this category is the GDP growth, as it's able to give an overall picture of the economy. Typically, the impact will be quite large, but it still depends on how far apart the actual numbers are from the expected. An increase in GDP growth shows a healthy economy which will strengthen the currency. However, if there is slowing growth, it is likely that the banks will cut rates to try spurring on the economy. By cutting rates, investors will move their money out of the country, and this will eventually lead to a depreciation of the currency. Hence, it will be seen as a bearish signal. Fourthly and lastly, we have inflation indicators such as the inflation rate. This is probably the most important indicator as central banks try to manage inflation by using interest rates. It measures how much the cost of goods and services are going up or down. Now, very often the main purpose of central banks is to ensure that the inflation rate may remain stable. For example, most developed nations aim for about 2% inflation. If inflation is higher or lower than that, the banks will usually use interest rates as a tool to control inflation. If inflation is too high, it could be a sign that banks will start to raise interest rates to slow consumer spending, and hence, a higher than expected or targeted inflation rate will usually be seen as a bearish signal for the currency.